Welcome to Behind the Advice, the podcast for Australians living abroad who want to maximise their financial situation. I'm your host, Mitchell Kelsey, a financial advisor at Runway Wealth Management, and in each episode, I'll be sitting down with other experts and professionals to get their insights, stories, and expertise on key concepts for Australian expats, as well as providing my own perspective. With this being a financial podcast, there is a disclaimer, so any information that you hear in today's episode is general information only. It is not personal advice, so it does not take into account your personal situation, goals, or objectives. If you do need personal advice, feel free to reach out to us at Runway Wealth Management for personal financial advice. Welcome back to the audio version of the Runway Report Newsletter, our monthly newsletter for all things markets, the economy, and financial news out of Australia impacting Australian expats. Without further ado, let's get into the July edition of the Runway Report Newsletter. Now, the agenda each month remains the same. It starts with a note from myself. We then get into an Australian expat insight. I'll then move through the market movements for the month of June, and then we'll finish with an economic update. Now, the note from myself this month is the announcement that we've been nominated as a finalist at the 2026 Australian Wealth Management Awards in the Advisor of the Year High Net Worth category. Now, this recognition reflects the trust our clients place in us, the long-term relationships we build, and the dedication of the entire team here at Runway Wealth Management. We look forward to attending the awards in Sydney in August and celebrating alongside colleagues from across the profession. And certainly want to thank our clients for your continued support and the trust that you place in us. Now, the Expat Insight this month is touching on the capital gains tax changes, which take effect from the 1st of July 2027. Now, before we get into this discussion, I just want to preface that these rules are highly complex and they are very much interconnected with the existing tax rules, and you should certainly not look to interpret them yourself and seek tax advice in terms of how they will apply to your specific tax circumstances. Now, what's changing from the 1st of July? So currently, from the 1st of July 2027, the current 50% CGT discount for individuals and trusts will be replaced by a new cost-based indexation model. So rather than automatically reducing a capital gain on the sale of an asset by 50%, eligible taxpayers will instead increase the asset's cost base for inflation. So it'll be indexed by the rate of inflation over the ownership period, thereby reducing the taxable gain on the sale of that asset. Now, there are a few moving pieces to this, so let me get into the details of that. Now, particularly for Australian expats, the key issue is around Australian tax residency and how that applies with the new cost-based indexation method. So the way that the rules are currently legislated, the cost-based indexation will generally only be available where an individual has been an Australian tax resident throughout the entire ownership period. And certainly individuals who are foreign resident during that period are not expected to qualify for the new indexation benefit. So this has been a key or a contentious point in the legislation, that where you're a non-resident for even one day in the ownership period, you are unlikely eligible for this new cost-based indexation method. Now, that does sound quite punitive, but as I get into the details, it's not as bad as the headlines suggest. But certainly the changes mean that the timing of becoming or ceasing an Australian tax resident are going to have a material impact on the eventual capital gains tax outcome. Now, this isn't the first time that residency or tax residency has affected capital gains tax concessions. So under the current rules, Australians who are non-resident for tax purposes are generally not entitled to the 50% CGT discount anyway for the period that they are living overseas as non-residents or foreign residents. And it's worth noting as well that many of our clients own Australian and international share portfolios while living overseas. And in many cases, these assets, so shares, ETFs, managed funds, these are not considered taxable Australian property. And as a result, they are generally going to continue to fall outside of the Australian capital gains tax net when they're disposed as someone who's a non-resident for tax purposes. But certainly, if those investments continue to be retained until while overseas and then as part of relocating to Australia and after returning to Australia, future disposals will likely be subject to the new CGT rules. So this means that the timing of both your residency and future asset sales becomes increasingly important. Now, there will be some new transitional rules that will be in effect. So how this will work in practice is for assets acquired before the 1st of July 2027, the capital gain will effectively be divided into two distinct components. Now, the first component is looking at the growth that the asset experiences from the acquisition date up until the 30th of June 2027. And the gain for that period will generally continue to be taxed under the existing CGT rules. So they are still eligible for the 50% discount where applicable. And the other component will be the growth on the asset from the 1st of July 2027 onwards. And that'll be subject to the new cost-based indexation regime. So this means many long-held assets will require two separate CGT calculations when the asset is eventually sold. Another important note is the reforms also introduce a minimum 30% tax rate on capital gains accruing from the 1st of July 2027. So you're going to have a calculation on the growth for the period up until the 30th of June. That will be subject to marginal tax rates, and CGT concessions will be available. However, for growth beyond the 1st of July 2027, there's going to be you'll have to use this new cost-based indexation method, and there will be a minimum 30% tax that will apply to that particular gain. So that's how it will work in practice. It's quite complicated, but there's essentially going to be two capital gains tax calculations that will need to be worked out. Now, what's quite interesting, after reading through the explanatory memorandum, which is essentially the document that's issued by Treasury to explain how these new changes will apply in practice, there was a section that essentially just acknowledged that there is likely to be some further refinements around the way that the rules work for non-residents for tax purposes, and particularly how the cost-based indexation method will work for Australians who have a period of non-residency. I've just included the relevant section here. So certainly this will be something to continue to monitor, and something that we'll certainly continue to monitor for new developments, because it's likely we'll see some continued updates to the current legislation. So this is something we'll continue to keep you informed of as guidance becomes available. If you're looking to understand how the new CGT rules work in a little bit more detail, we've posted a blog on our website which goes into the calculations and the nuances in a bit more detail. Let's move into the market movement section now. So looking at the month of June here, so June saw more of a mixed month across global financial markets. Investors were balancing optimism around corporate earnings and artificial intelligence against renewed concerns over inflation, interest rates, and geopolitical tensions. Among the major asset classes and indexes, we saw Japanese shares led major share markets, with the Nikkei 225 gaining 5.63% in the month. European equities also performed strongly. We saw the Euro Stoxx 50 index. It was up 4.59% in the month. Indian shares rose 1.35%, while the UK FTSE 100 gained 0.84%. Australian shares posted a modest gain of 0.5%, while US markets were weaker during the month of June. The S&P 500 was down a bit over 1%, and the NASDAQ index, or the NASDAQ composite index, fell 2.81%. We also saw Bitcoin experience some volatility during the month. It declined 19.6%, and the Australian dollar also weakened quite significantly during the month. It fell 3.74% against the US dollar. Now, looking at the Aussie market in particular, and looking at some of the sector performance over the month. So the healthcare sector was the strongest performing sector. It rose 12.5%, and it staged a really strong recovery after a challenging couple of months. Consumer staples also gained. That sector was up 12.5%. Energy was among the weakest sectors. It fell 9% as energy prices declined amid hopes of easing tensions in the Middle East. And then we also saw the resources sector. It declined 7.8% in the month. The decline in the Australian dollar is worth noting. So it fell 3.74% during the month against the US dollar. And that's mostly a result of the change in interest rate expectations in the US, with the Fed chair Kevin Warsh likely looking to hike interest rates before looking to cut interest rates anytime soon. And then meanwhile, we've got the Reserve Bank here in Australia, and we're likely on hold for some time to come. We've kind of ceased out our current interest rate hiking cycle. Looking at global markets now, so global markets were influenced by several competing themes throughout June. There was, while enthusiasm around AI and resilient corporate earnings initially supported equity markets, investor sentiment softened towards the end of the month as central banks adapted a more cautious tone on inflation and the potential for higher interest rates. Just looking at a few standouts in the share market performances. So we saw US markets, they briefly reached fresh record highs early in the month, but they did retreat towards the end. So as I said before, the S&P 500 was down a little bit over 1% and the NASDAQ was down 2.8%. Asian markets were mixed overall. So we saw Taiwan's share market continued to benefit from AI-related optimism, while South Korea experienced more volatile trading as investors reassessed the outlook for semiconductor demand. So the index that we have tracking these particular stock markets, the S&P Asia 50 index, it finished the month down a little bit over 1%. And then geopolitical tensions resurfaced late in the month after negotiations between the US and Iran broke down, adding to that market uncertainty that we saw. Now, one of the month's standout market events was the initial public offering of SpaceX, so Elon Musk's SpaceX. So that listed on the 12th of June. Now, interestingly, it listed on the Friday. The shares surged 19% on the first day of trading, valuing the company at approximately US 2.1 trillion. And remarkably making it the 6th largest company in the United States. Now, despite its high-profile listing, SpaceX is not expected to be included in many exchange-traded funds until at least mid-2027. Now, this is because it must first satisfy the S&P or the Standard & Poor's Index Committee's standard waiting period before becoming eligible for inclusion in major S&P indices. Now, the public listings of SpaceX alongside the anticipated IPOs of OpenAI and Anthropic have the potential to really broaden investment opportunities, and it's certainly generating significant interest across global share markets. Moving into an economic update now to round off. So the Australian economy, to start with, if we look at the Reserve Bank of Australia, they left the cash rate unchanged at 4.35% in June. As widely expected, the decision marked the first pause in the tightening cycle that began in February 2026, following a cumulative 0.75% increase over the previous 3 meetings. Now, while the RBA acknowledged that financial conditions have tightened, it also reiterated that further rate increases remain possible should inflation prove more persistent than expected. Now, looking at the latest inflation data, which was released in June, it showed that annual inflation here in Australia continued to ease in the 12 months to May, although underlying price pressures remain elevated. So if we look at the headline rate of inflation, it eased to 4% in the 12 months to May. Meanwhile, we had the trimmed mean inflation, which is the Reserve Bank's preferred measure of tracking inflation. It was 3.6% in the 12 months to May, so still above the Reserve Bank's target of 2 to 3%. So markets will closely be watching the next inflation release, which is on the 29th of June, which will include both the June monthly CPI and the latest quarterly inflation figures. So these inflation figures will certainly be assessed by the RBA ahead of their next policy meeting, which is scheduled for the 11th of August this year. Looking at the global economy now, so global central banks continue to make different approaches to monetary policy as inflation trends diverged across major economies. In June, we saw the ECB, or the European Central Bank. They raised their deposit rate by 0.25% to 2.25%, and this was the first rate increase in the last 3 years by the ECB. In Japan, the Bank of Japan increased interest rates by 0.25% up to 1%, and meanwhile, the US Federal Reserve and the Bank of England both left interest rates unchanged. Now, the US Federal Reserve's June meeting attracted particular attention from investors as it was the first chaired by Kevin Warsh. So while the decision to leave interest rates unchanged at the meeting at 3.5 to 3.75% was widely expected, policymakers adopted a more cautious tone on inflation than markets had anticipated, and that resulted in that market volatility that we saw towards the end of June. Also in the US, we saw labor market data showed that the labor market was softening. There was 57 jobs added in the month of June, well below expectations of 114,000. And although the unemployment rate edged lower in the US to 4.2%, the improvement was largely driven by lower workforce participation rather than strong employment growth. That's all for this month's edition of the Runway Report Newsletter. We look forward to bringing you further episodes in the future. Thanks for tuning in. Thanks for tuning in to today's episode. If you want to learn more about Runway Wealth Management and how we help Australian expats, feel free to jump onto our website, runwaywealth.com, and we're also on all the social media platforms.